Good day, g'day, g'day. Thank you all for joining us for the last Life After Hours for the year. Life After Hours is that time of the month when we shine a light into the dark recesses of personal finance. As the last one of the year, I wanted to take the opportunity just to work through the events of the market and the impact that had on your portfolios. So thank you for joining us. I'm just going to take you through some of the highlights on what happened to the portfolios and what that means for your returns. Of course, 2025 so far has been an extraordinarily good year, as indeed was 2024. So it's important not to get too used to great years. Great years are great, but they always do come in the midst of not so great years. It's important to understand why it did what it did. This is an opportunity for me to show you what happened and for you to ask questions. It's probably a good time for me to acknowledge the Camaragal people, the earliest recorded inhabitants of the land that today we call North Sydney. As I said, we are seeking to make sense of 2025 and just give you a few insights and takeaways on the magical market moments that we've been through. But really what I wanted to talk about was the story of the year was probably gold. And it's certainly got a lot of press, a lot more press this year than we've seen in decades. Of course, we had the mid-year Trump tariff tantrum. And then, of course, 25 wouldn't be 25 without talking a little bit about the AI hype or bubble or whatever you might want to call it. So with all that said, let's just start with the great year. So these are outstanding returns because we had an outstanding year in the market. So the high growth 90 portfolios did almost 19%. The slightly more conservative growth 80s did 17.5%, and the fairly conservative balance 70 did 16.5%. So they are great results for diversified portfolios. Not because we're necessarily investment geniuses. This is what the market delivered. The job of a good portfolio constructor and manager is to make sure those market returns end up in your pocket. And that's the magic, really. When we look at the 12 months, it's not quite 12 months, it's 11 and a bit months, but you'll see that the year started reasonably strong. And then we had that big dip in April when on the first of so-called Liberation Day on the 1st of April hit and portfolios were down 5-6% for the few days. But it was like the COVID downturn, very short-lived. And this really is about demonstrating the stay the course, that those who reacted badly, either in anticipation of what was going to happen on April 1st, as Peter Lynch says, more money is lost preempting downturns than in the downturns themselves, or having seen what a 5 to 10% fall in a few days felt like, reacted and moved to cash, that this was all over in a very short period of time. And then we had a very significant run up to mid-October and then a slight pullback from mid-October. But overall, they are, by historical standards, great returns. But probably more importantly is where they came from. So one of the things that I always like to use as a comparator, I'm not sure I'd call it a benchmark, but I always like to compare things to what I call the Reddit Trinity. So that's the VAS, Vanguard Australian Share Fund on the Australian side, which tracks the ASX 300, the S&P 500, so broadly the Vanguard so-called Total Share Market Fund or VTS, and the rest of the world being VEU. And they're the common starting ETFs for many people, so I call them the Reddit Trinity. And as you'll note, that notwithstanding that they are effectively 100% equity portfolios, 100% large company portfolios, the more diversified LifeShare portfolios delivered much more strongly. That raises the question of, well, why? And that's the next point. The first contributor to that was obviously gold. Gold is up 50% for the year. It's up over 100% for 24 months to today. And that's not a historically normal return. Gold historically, since 1971, when the US came off the gold standard, has delivered about 8% in US dollar terms. And that's a good defensive return, but the last 2 years have been outstanding. And you can see that's significantly higher. But that's not the only story. The other story is that small caps, that is companies outside the ASX 300, roared back into the positive. As a general rule, and this is part of the Farmer French portfolio construction theory, which says small companies outperform big companies. That's true over longer periods of time. But in the US, with the dominance of so-called Magnificent Seven, the Facebooks, Googles, Amazon, Nvidia, Netflix, Tesla, it's not been true. So those big companies have dominated the US market. And so the small cap, so-called small cap premium, that is the amount of outperformance you should expect from smaller companies, hasn't really been all that much in evidence over the last few years, but it certainly came roaring back this year. And the other thing that's important to note, if you look at the difference in performance between the two managers, so we use two small cap managers, they're both active, and they have fundamentally different philosophies. They pick from different universes. So the blue one at the top, SGH, that's the SG Hiscock Emerging Leaders Fund. That does include some resources companies, and that return is to a large part due to lithium and rare earths, whereas the Ausbil one is more traditional industrial consumer business. But both of those delivered significantly higher returns than the large cap indexes this year. And probably the other story, which we'll come back to later, is that the recent outperformance in the US market relative to the rest of the world wasn't in evidence this year. So many people whose only experience of investing is the last 10 or 15 years will have got used to the concept that the US is where the growth is. And that's been true over that period. It's not been true over 25 years, and it's not been true over 125 years. But the last 14 years in particular, the US has outperformed, and much of that outperformance can be put down to a handful of tech stocks. So that's an example of a recency bias, and you've got to be careful of extrapolating from the recent past. There is no particularly strong economic argument as to why the US should outperform in the long term. Share returns are to a large extent driven by GDP growth, and the US GDP growth hasn't been materially ahead of the rest of the world for that period. So reversions to the mean will eventually have to happen, and we're starting to see that happen now. We don't do forecasts here, but I think there is a bit of a sea change there. That could all change in 2026, but we've definitely seen that rest of the world rebound. But I do want to start with the gold story. And it can be tempting to see the headlines, see the queues outside the gold bullion store on Martin Place and go, shouldn't we be selling here? This is an all-time high. Well, gold's been hitting all-time highs since the 2020s. In fact, most markets that trend upwards, and they're the ones you want to be investing in, will continue to hit all-time highs. And you should never shy away from that. To think about gold in terms of returns is sort of the wrong way of looking at it. Just want to spend a little bit of time going through the rationale as to why we do what we do with gold. It is a bit of a divisive asset class. The great Warren Buffett, who's just retired, said that gold is just about the last asset he'd ever want to own. Whereas Ray Dalio, famous hedge fund operator, said that the only reason not to invest in gold is if you don't understand it. and you just don't understand the economics, there is no sensible reason to not include it. I think I would fall somewhere in the middle of those two extremes, but we have at Sherpa consistently for a decade, and I personally for 20 years have included gold in my portfolio and the portfolio that we manage for our members. Pre-2007, that was a harder tool to do. You needed to do it with physical gold or to try and simulate it using gold mining stocks, which don't quite behave in the same way. But 2007 saw the launch of the gold ETF, and that's today how we deliver our gold allocation. So this is just putting the last couple of years' returns in context. This has been 2 years of great performance where gold is up 6 times since 2007, which was the launch of the gold ETF, but that really has accelerated since 2022. But like I said, that's not the real story. Gold, think about it as being a defensive asset there to smooth out the ups and downs in your portfolio without giving up too much by way of returns. And it does this in two ways. So generally when markets decline, investors across the world flock to the US dollar as a safe haven, which has the effect of pushing the US dollar up relative to most other currencies. And that's the black curve on this chart. So that shows that in these market circumstances, and I've just tracked most of the reasonable declines since the GFC, and that pushes the US dollar up. The Australian dollar, being a commodity currency, usually gets hit worse than most. So if you're a Canadian, South African, or Australian, this is a big story for you. And so US dollar rises, Australian dollar falls. So assets like US shares, or most overseas shares generally, because they're denominated in US dollars, that value goes up, which offsets the fall in the US dollar price of those assets. That's the argument for investing in overseas shares generally and not hedging the currency, because part of the benefit in investing overseas is you get this currency damping, which helps smooth out your portfolio. And gold does sort of the same thing, because investors in tough times go rushing for the security of gold. So the gold price goes up. Gold price is denominated in US dollars. And so you get this double whammy for Australian, Canadian, and South African investors. That's part of why you're not going to see this story play out when you watch content on the internet, because most of that content is US. Neither of those two phenomena play out for US investors who are investing in US dollars. The gold price obviously has the effect, but you don't get the double whammy. So here what we're seeing is that the black line shows, starting in 2010 at the left, share market falls. That's the gold colored graph, and US dollar goes up. And then you overlay on top of that gold going up, and you get that double whammy. And we see the same thing play out in 2011 and in 2018 and in 2020 and in 2022. I haven't quite seen it in 2025, because 2025 was generally an up year. So it's not often that we see gold rise at the same time as equity markets being strong. That's really a reaction to the geopolitical instability that we're seeing, and to an extent the concerns about the US deficit, which remains stubbornly high. And it's been stubbornly high for a very long time. I remember when I was in business school in 86, my thesis was on what they used to call the twin deficit, the current account deficit and the budget deficit. The US had been running deficits for years. And since 1986, that's almost 40 years ago, they've had 2 years of surplus. Whilst in theory, the US, because it can print more US dollars, it's probably not too constrained by borrowing. But nevertheless, the US debt service, because the government has chosen to borrow it, not to print it, is now more than the defence budget. And that's an unusual position for any major economy to be in. But nonetheless, this just shows markets get the wobbles, US dollar goes up, gold goes up, double whammy for Australian investors. So that's the theoretical backing for why we do what we do. But I just want to take you through what it actually looked like as we went through the last few downturns. Obviously, the GFC, 2007, 2008, in fact, all the way through to 2010, 11, really, was the last prolonged downturn that we've seen, and that's now 17 years ago. And upside since 2010 means that most investors under 40 have never seen a situation like this. So it's very easy to be an aggressive investor. To paraphrase Mike Tyson, everyone's an aggressive investor till he gets smacked in the mouth with a deep and prolonged downturn. I'm not wishing one to happen, but you've got to expect that these will happen 3 times in every 20 years at least. So in your investing career of 50 years or more, you have to expect to see a half dozen of these potentially, and making sure your portfolio is positioned to weather these and for your mental state to allow you to stay the course is the key to getting this right. So GFC, what we saw was that the share market peaked in November 2007 and hit this long grinding downturn with a big shock in September of 2008. But it kept going down till almost 2010, and we see that gold went in the opposite direction. So in that period of almost 4 years, you've got almost a 60% difference in returns. Charts do look quite different. So obviously you wouldn't have had 50-50, but 10% gold would have weathered that downturn quite a bit. The next time we saw a market dislocation was in 2018, as governments tried to wind back on the liquidity and support for growing economy. Bit of a mixed year. So we had a decline in the first quarter and we had a strong period in the middle of the year, then a strong recovery to the end. Again, gold is more or less tracking in the opposite direction to the share market. In all this case, I'm using the ASX 200, that's the 200 largest companies on the Australian share market, as a proxy for the market. You'll get a similar result if you use the S&P 500 or the MSCI World. But generally what we're seeing is that the two move in opposite directions, and that's how you get the benefit. COVID was another really strong example. We had that very sharp decline. Market peaked in February of 2020. And we had that really sharp drop into April when it all started to look pretty scary. And then the slow grind up to end the year almost square. Certainly the financial year to June 30, 2020 was a positive, net positive. And the ASX 200 ended up the calendar year pretty well square. The US recovered a bit faster. But of course, gold went in the opposite direction in US dollar terms. But over the year, both effectively returned to zero return. 2022 was a really interesting year. That's interesting in the Chinese may you live in interesting times sense, that both bonds and equities both fell. In fact, that was the first year in either ever or in the post-war period where both delivered negative returns, and gold came along and delivered a modest return, which meant that the life Sherpa portfolios were still down, but only down modestly. So that's really the story. 2025, I've added the S&P 500 here just to show the US situation. So over 2025, and this is the end of June, where you see the S&P 500 at the bottom one, it just recovered. So from the peak in February, we ran down through the April dip into Liberation Day, and then a slow grind upwards. The Australian market recovered far more quickly to end the year up. And of course, gold was up strongly for the year and went in the opposite direction of that dip. This is the real story for gold. The fact that you got a 50% return this year is sort of academic. And it is our first port of call for defensive assets. So when we go from 100% growth to 90% growth, the first 10% is filled by gold. And it does give you better diversification than bonds. So this graph just shows for all of those years what happened to bonds and gold. So when we look at the 21-22 period, when we're having that strong recovery out of COVID, gold went backwards. So people were getting relieved, the world was back into track, and bonds were down, gold was up. And that's sort of interest rates recovering. So as interest rates went up, bond prices fell, but gold was strong. Whereas in the early part of this is 2015, bonds were up and gold was down. So it just gives you that better diversification factors than bonds. So that's really the gold story. It's generally a very different story to the bond result, even though most people would start with bonds as their defensive allocation. So traditionally, you'd have looked at a equities and bonds portfolio. Today, we go a bit beyond that. We use real estate and infrastructure as a slightly defensive growth, and we also use gold on the defensive side. So looking at the Trump tariff tantrum, it was a very short, sharp dip, a fairly deep dip, which was well telegraphed. We did see markets generally trending down across the world in the lead up to it, as nobody was quite sure what was going to happen. April 1 comes along, and then Trump chickens out, markets recover, and governments around the world are making trade deals with the US. So it was all over in Australia within a month. The US took a little bit longer, didn't recover till July, but we've still ended the year on a strong note. A little bit off the October highs. By all measures, that's a strong response. And of course, again, very strong message here says staying the course is the key to get these returns out of the market into your pocket. The other interesting thing here is a bit of a complex graph, so I'll take you through it. We spoke a little bit earlier about most people, and so if you look at the right-hand side of this graph, the 14 odd years from 2011 to today, the blue line is the difference between US and the rest of the world. Blue area above the zero line shows the US outperforming, and the blue sections below the line shows that the rest of the world outperformed the US. And the black line is just a 5-year rolling return. So you can see that it lags the blue area. What this is showing is that US outperformance is not preordained. It's certainly been true for the last 14 years. It wasn't true in the first decade of the 21st century. And it wasn't true in the 70s and 80s necessarily. These things go in cycles. Equity returns are broadly linked to GDP growth. And so over time, you expect this to revert to the mean. So US exceptionalism cannot be assumed going forward. It also means that timing the market, so choosing when you would have got in and out of the market based on that sort of February to April decline, and when to get back in again, extraordinarily difficult exercise to pull off. And ultimately, diversification matters. So I think they're the three lessons we should take from 2025. I'm not suggesting that the US is going to fall significantly in the next period, but we should probably be expecting to see lower returns out of the US than we'll see in the rest of the world. And then the final message, I think, from 2025 is the AI story. Clearly, we're seeing a huge investment, potentially trillions of dollars being invested in AI story. And that's from the chip makers like NVIDIA, the foundries that make them like TSMC in Taiwan, the companies that make the machines that make the chips, ASML out of Holland, for example. We're also seeing massive investment in the data centers themselves, which is in part a real estate play. And that's why we're seeing Goodman Group, which makes up 40% of the Australian property index, powering ahead. They also use massive amounts of power. So we're seeing a fair bit of development in the electricity infrastructure, both from a generation side and from a distribution side. It's flowing on to the people who service those. So the electrical contractors, the suppliers of air conditioning, the people who provide the racks and security systems. The AI companies themselves are largely funding this from equity. So this is not a debt-fueled 1999, late 90s internet boom. These companies investing in these are extraordinarily cash positive. So the Googles and the Amazons, they're just money printing machines, and they're recycling that cash and these massive cash reserves they built up to fund this development. There's also a fair bit of cyclical stuff where the purchase of the chips is being provided by new equity raised by the customers. So in some ways, that's a bit like the telecom equipment manufacturers providing vendor finance to the rollout of the mobile networks in the late 90s. The bit that bothers me is that at the property side, much of that is being funded by private credit. Should we end up with a surplus of data center capacity, just like we ended up with massive surplus of fiber optic capacity in the late 90s, those property companies could very well struggle. And because they're being funded by private credit, anyone who's invested in private credit could be exposed. And because it's called private credit for a reason that you can't actually see where your exposures are, that's where I get very nervous. And that in part is why we invest in global real estate, which is much less development focused compared to Australian real estate. So the Vanguard Australian Property Fund, or VAP, has massively outperformed the global equivalent. And 40% of that is the Goodman Group. They're building data centers like there's no tomorrow, and logistics facilities for the Amazons of the world. So I'm not suggesting that's a challenge today. And of course, we don't do forecasts here. But that's, I think, the bit that keeps me awake at night. To answer the question about whether this AI thing is a bubble or not, I think it's useful to go and have a look at what is a bubble, what makes a bubble. Robert Shiller, who wrote the book Irrational Exuberance, which was taken up by Bernanke in the 90s, identified a half a dozen key indicators of what a bubble might look like. Clearly, sharp increase in prices. Tech, yes, we've seen that. Overvaluation, prices far exceed the historical norms. And certainly we're seeing valuations looked at on a price to earnings ratio. That is, what multiple of last year's profits do you have to pay to buy a share in NVIDIA? Answer, massive. Is that just because forecasts haven't caught up? We don't know, but I'm not sure when you look at the levels of growth that are built into those assumptions that were anywhere close to material overvaluations yet. The third point, the narrative, the popular stories, the AI is coming for our jobs story. This is the story that was told about the personal computer in the early 80s. It's the story that was told about the internet in the 90s, neither of which led to any job losses. I'm not sure that AI is going to be materially different to that. I think we may very well be doing different jobs. We may very well be doing different things. Some jobs will become more and more important. Some will become harder to justify their premium. I'm not sure I'd want to be an IT developer. And we're certainly seeing layoffs in the tech space, despite this build out. I think the jury's still out on that one. Tales of significant earnings, get rich schemes. There's a bit of that around. And certainly when you look at where we moved from the first $1 trillion company to the first $4 trillion company, that didn't take very long. And so that's an area of concern, I think. Envy and regret, fear of missing out, huge deal in the 90s. Being in investment banking in the 90s, when all these IT bankers were talking about new ways of valuing businesses, that earnings and profits and revenue were no longer relevant. We looked at numbers of users. We looked at anything to justify the prices. We're not anywhere near that yet. Of course, the media frenzy. We're seeing a lot of media frenzy. So there's Schiller's 6 markers. The other thing that's necessary for a bubble to form, which is why we see them in real estate, but not all that commonly in the stock market, is you need to have divergent views and the inability to hedge the negative sense. So if you form the view that real estate's getting too expensive and you think it's overvalued, you can't actually trade that position because it's very hard to short property. Sure, you can sell what you've got, but it's pretty hard to go short the property market, whereas there is still extensive short positions in many of these players. So I think we're a long way from a bubble. This is a bit of an obscure slide, but this is really saying that when you look at current PEs, that is price to earning ratios, the number of years profit you have to pay to buy a share, they are by historical standards high today. I don't think anyone would argue about that. But today's valuation is actually not a particularly strong indicator of next year's returns, which might sound a bit surprising. So if it did, there will be some structure to this diagram. So this diagram just posts, for every year, it looks at the current year price to earnings multiple average, and then plots that against the return you achieved in the year after that. On the S&P 500, just as an example, they would form a trend if there was a link. And this is a shotgun blast random. So there's nothing here that tells me that there is any particular forecasting power in today's price to earnings ratio. That's not to say we should ignore it, but I think that even though we have a share market that's heavily dominated by these players, if you're invested in the Vanguard Global Share Fund or any global equity index fund, you have 20 cents in the dollar invested in 10 of the big AI players: NVIDIA, Alphabet, Microsoft, Amazon, Broadcom, Meta, Taiwan Semiconductor, Oracle, ASML, and Palantir. That's a heavy concentration by any measure. It's about the same as the Australian share market concentration in financials, to put it in context. And it's less concentrated than the top 10 in the Australian share market. But nonetheless, many of those companies, NVIDIA at $4.3 trillion, that was one not that long ago. Alphabet at 3. So, it's not that long since we had our first $1 trillion company. And now we have 1, 2, 3, 4, 5, 6, 7 of them here in the top 10. And so, yes, it's concentrated, not as much as you might think by reading the paper, and possibly a good reason why you don't necessarily want to be allocating your capital in accordance with global equity indexes. So we've always split the US out from the rest of our global allocations. So we've been using IVV, that's the BlackRock S&P 500 fund, to deliver the US, and then we use an ex-US global equities to provide the rest of the world. And that allows us to tone down how much of that money goes into the US. So today the US is 70% of the global share market index, yet the US is 26% of global GDP. On a nominal basis, about 14% on our purchasing power parity. So we've under-allocated the US. So we're sitting at about 40% today. That's 40% of the global equity component, whereas the index is sitting closer to 70. And we think that's prudent. And then always good to put it in the context of history, and having lived through this and spent some time fixing up some of these assets that came off the wrong side of that 99 borrow. So the reddish color here is 1997 to 2000. The blue line is 22 to 2025. So we have a long way to go. And there is a fair bit more substance to the businesses that we're seeing making up those multiples. There's not too many grocers.com or pets.com that we saw back then. So this is not 1999, to be very clear. If it keeps going for the next 2 or 3 years, well, maybe we could get there. But today, we're a long way from that. So that's really all I wanted to say about 2025. It's a great year, and it's great because the major indexes produced an average to slightly above average return. Gold and small caps delivered massively. Infrastructure's coming roaring back from its COVID downturn. And even we're starting to see some green shoots in the global real estate market, despite the fact that office property is not worth what it was while we still work at home. We're starting to see some physical transactions come through in the real estate market. So the Australian residential real estate market continues to grow at above average growth rates. Sydney's 40-year average is about 5.8% a year. I think we did about 6.5% last year. So whilst interest rates remain low, that's probably likely to continue. I mean, I started the year with a view that the risk on interest rates was on the upside rather than the downside. I think the RBA is starting to make those sort of noises. So I think the probability that the next change is up rather than down has definitely increased. 2 days ago, the RBA held rates, but they were very much hinting that the risks were on the upside, that inflation's remaining stubbornly resistant to the application of the interest rate lever. And so therefore, up is more likely than down. So that's 2025 in a nutshell. So let's see what we've got in the questions. Question around the US and what impact the US deficit is likely to have on the US economy. The Fed dropped rates this week again, and the gap between US and Australian rates is historically anomalous. That's not usually what we see. But, the US is slowing. The tariffs impacting consumer sentiment. The US economy is much more heavily driven by consumer behaviour than ours is. The Australian economy is heavily influenced by export performance, which largely means commodities, and much more government stimulus spending around infrastructure largely. So the US economy is quite teetering on the brink, but it's certainly much more challenged than we would have. There's certainly seen significant layoffs in the tech space. Government spending is not a particularly big part of that, but the US consumer needs to get happier, and I'm not sure a 25 basis point cut's going to deliver that. So very much concerned about the US domestic economy, and it's potentially got impacts elsewhere. So I would expect that the US underperformance relative to the rest of the world will continue. I don't see it being a particularly negative year, but probably a sub-average year. None of that makes me want to change our current underweight position in the US. I said 40% compared to 70% is a material underweight. I'm not sure I really want to go much lower in the face of the growth coming out of AI. So a question about silver. If gold is good, is silver better? Silver doesn't quite fulfill the same role that gold does. Silver is to some extent a byproduct of gold mining. That gold and silver often occur together, and silver probably has more industrial uses. It's certainly not part of the central bank reserve space. It's more of a commodity play rather than a defensive play. So we won't be adding that. And the same could be said for platinum, rhodium, palladium, all of those big precious metals. The commodity stories, I think, continues to be cobalt and lithium. and the rare earths in general. So no, we won't be adding silver anytime soon. And if you're ever interested in the gold versus silver story, have a look at what happened to Isaac Newton. He's the Apple and gravity guy. He was largely responsible for forecasting the relative price between gold and silver, because the UK ran a dual metal fix and they got hopelessly out of whack in the 17th century. And Isaac Newton lost one of his two fortunes based on that. He made and lost a fortune in the South Sea bubble. So no silver for us. That's really, I think, all I want to say about 2025. Great year. Don't get too used to it and don't spend next year's return yet. And so with that, let's draw 2025 to a close. Thank you all for joining us on these evenings. It's a pleasure for me to share the analysis that goes into our portfolio construction and management. Hopefully this has given you a little bit of insight that it's not just a question of lining up ETFs and ranking them by return and price. There's a fair bit in working out how they work together. And a team of champions does not a champion team make, as they say. So with that, have a great holiday and we'll see you at Life After Hours in early February. Have a great Christmas. So bye for now.